Well, good morning, Bob.
Good morning, Bill.
We're here at FNC's Morning View this morning, and we're talking about the role of finance in society.
Yeah, there was an article that came out recently by a couple of Harvard professors.
Oh my goodness! Now, what do they know about? I thought finance was at Wharton, but that's okay. Go ahead.
Anyway, these guys, Robin Greenwood and David Sharfstein, wrote a paper called "The Growth of Modern Finance,"
Which it has grown.
It's grown huge. I mean, financial services, as a total percentage of GDP in 1980, was 4.9%. By 2006, it was 8.6%.
Awesome.
So it's taken over a huge portion of all of GDP, and the question is, okay, first of all, what's driving that? And secondly, is that necessarily good for society?
Well, let me ask you a question. Do you believe that money is attracted to brains and vice versa?
I think it's a totally unrelated correlation.
Oh, no. I think money is attracted to brains and vice versa.
Well, I know a lot of really smart physicists that make nothing.
Like I said, money's attracted to brains. Okay. All right. So let's talk about that, and let's talk about really the overall allocation of capital in society. Typically, we have financial activities and we have investing activities.
Right.
And years ago, I believe they gave the Nobel Prize or something close to that. Maybe it was the Nobel Prize in economics for this concept of separating financing decisions from investing decisions.
Right.
Now, have we allocated too much of society's capital to finance?
Well, I mean, that's the question. Basically, what they do is they said, okay, there are really three branches of financial services. There's securities, there's insurance, and there's credit, essentially credit intermediation, basically processing that credit all through the process.
People that are savers,
right,
that combine their savings, and an institution, an intermediary, then reallocates that out in the form of credit.
Right. And the two areas in which this has grown dramatically is not insurance. It is really in the asset management process, and in the essentially fees associated with mortgage, the extraction of the credit, and increase the amount of household credit.
Well, do you think our markets, because of this, have gotten more or less efficient? Or were they efficient to start? I'm talking about the credit markets.
Right.
Were they less efficient? Because one of the big roles of a credit market is to disseminate information about borrowers.
Right. And, you know, I mean, if you step back and say, okay, what are the societal benefits of these two areas, the asset management and the increased mortgage? Well, for the society, they benefit from the asset management by essentially lowering the cost of capital.
Well, you should get a return on that.
Exactly.
Right. So the first question is, do we get a risk-adjusted return on the capital allocated to asset management? That's the first question.
And then the second area is, by having all of this additional mortgage activity, you've actually increased the access to credit by households.
You know, it used to be that when you wanted a mortgage, you went in and you shook the hand of your banker.
Right.
You didn't have much choice. You pretty much took years ago. You pretty much took what the bank offered. Mm-hmm. If you wanted a mortgage, this was the deal.
Right.
And now we have lots of choices and lots of documentation. It's gone from a relationship to a transaction.
Exactly, and the amount of credit is grown dramatically. In 1980, it was about 48% of GDP, household credit, and by 2007, it was 99% of GDP.
Let's just talk about pocketbook, and let's talk about. You would think as markets grow, so would people's pocketbooks. So the pay would grow. Has the pay grown among the people in the financial sector?
Well, because of the fact that they're taking over a larger and larger portion of the GDP, their pay has increased much faster than the rest of the economy.
Well, for those in the industry, that's awesome.
It is. From a person trying to assess the benefits to society, it may be that there's some over-allocation of resources into financial services.
Well, let's talk about that. Let's first talk about asset management. We'll come to credit in a moment, but in asset management, do you think we're getting a sufficient risk-adjusted return, or is it too much of a risk-adjusted return?
I think what's happening, and the concern that people have, is that a great deal of the asset management fees are going solely to transferring the assets back and forth between portfolios.
Asset managers?
Yes, exactly.
Basically, asset managers.
Because their return is based, or their income is based upon essentially transactions.
And
right?
so that implies that what you're saying implies that they're really not beating a buy and hold strategy.
That's correct.
So on a risk-adjusted basis, we should just buy a diversified portfolio and go forward.
Exactly. And so that's one of the complaints that they point out, is that the amount of money that has gone into that segment has been very large. In part, the asset management fees have gone up because the amount of assets under management has grown dramatically.
And we're getting older as a nation, and so as we look at that, we're saving more for retirement. We didn't for a while. We were negative for a while, but now that's changed.
Right.
And so it seems to me like what you're saying is we're essentially potentially taking money out of the parking lot and putting a match to it.
That sounds like it to me.
At least in asset management.
Right, and it's nothing. I mean, I think that their argument is not that asset management is not a good thing for society.
So it might be good.
But that perhaps it has been over-allocated into
Are we overpaying?
Yes.
Oh my goodness. So by overpaying, you're taking part of the money in the parking lot, or you're getting a good feeling about it. You're getting some psychological benefit, but certainly not financial benefits, according to the article.
That's correct.
Okay, now let's talk about credit, and let's talk about the allocation of credit. Has it gotten cheaper? I mean, we've had this LIBOR scandal.
Well, certainly,
a lot of rates are tied to LIBOR.
Right. Certainly, there's no question that credit has become cheaper.
Has it become more available?
Yes, it has.
So what you're saying is that potentially that what we pay for that availability, you're potentially saying we're paying too much for that availability. Or are you saying that?
I'm not. This is actually.
I'm talking about the article.
The article. Right.
Okay,
the article is not necessarily
because
saying that we're
I've never known
paying
you
too
to have an
much.
opinion ever.
But the issue is, are we, by creating this easier access to credit, is that necessarily in the best interest of the country? Okay, because people are, I mean, virtually 100% of GDP is equal to the amount of household credit there is out there. That's a lot, and so since the downturn, of course, people are paying off a lot of that credit, and that's improving that ratio, so it's not 100% anymore. But that's still that people were heavily leveraged.
So all the credit might not be good.
That might not be good. And the other thing that they talk about is that it also led to the buildup of this shadow banking system.
Well, it was not efficiently priced.
Right.
If it had been efficiently priced, we would have had different outcomes on our loss severity, especially in the subprime.
Right.
But we didn't have it. We didn't see that.
Exactly. So people didn't fully comprehend the aspects of the shadow banking system. They were treating it as though it were a government-guaranteed banking system, very much like the GSEs, and it was not.
Well, in hindsight, some of it appeared to be because we had the government come in and grant charters to certain companies.
That's true, but we also had some number of
some bankruptcies,
right.
And so, but that was not sufficiently priced in the market because people couldn't tell whether you were going to have a guarantee or not. It was sort of an ad hoc deal.
It was ad hoc.
I mean, Lehman went down, and AIG did not.
Right.
And so it was sort of ad hoc.
Well, and as a result, what we're learning is that there were problems in that system. There was probably inappropriate support or guidance or pricing of that shadow banking system, that we didn't really understand the number of transactions that were going. Because one of the things that happens is that, if I lend you money, there's really only one step between me and you.
Would you lend me money?
No. It's hypothetical.
Okay. So this is an economics discussion, not a finance discussion.
Right,
okay, all right. Yeah.
But if I were to put money in a bank and the bank were to lend you money, then that's two steps, right? But in fact, in many of these credit things, there were many steps in the process. It'd go to the bank, and then it would go to secondary market, and then they would securitize it, and then that would be split up, and so they were just step after step after step, and nobody understood that structure. And all of those steps basically resulted in a lot of the latter steps being circular, because this person would sell to this one, who would then sell back to the first one. And so it was a whole mixed area and made it very fragile.
And so for all of you entrepreneurs out there, it appears that this might be a market for lots of need for efficiency.
Exactly.
And so...
And transparency.
And transparency. And so the credit markets, do we have too much credit?
It's getting better. We did have too much credit. Now it's getting better.
All right. Well, this is FNC's Morning View. I'm Bill Rayburn with Bob Dorsey. And Bob, I would loan you money. Lots of documentation, but I'd loan you money. You all have a fantastic week.